In recent years, ETFs have become one of the most popular ways to invest, especially for beginners. And that makes sense, because they are simple, offer diversification, and are generally considered safer than picking individual stocks. However, what is not often talked about is that many investors make basic mistakes without even realizing it, and those mistakes can significantly impact their returns. In this video, we'll look at the most common ones and how you can avoid them. If you're just starting to invest in ETFs, it's very easy to make mistakes. Not because you don't know enough, but because many things seem simpler than they really are. Even experienced investors have gone through these stages. In this video, we'll look at the most common mistakes beginners make with ETFs, so you can recognize them early and avoid them. Because at the end of the day, it's not only about what you invest in, but also how you invest. So let's begin with the first, and perhaps the most common mistake most beginners make. The first and most basic mistake is that many investors don't truly understand what they are buying. They see an ETF, notice strong returns, and invest without checking what it actually holds. For example, they may think they are diversified, while in reality they are heavily exposed to just one sector, such as technology. An ETF may look safe, but if you don't know which companies it contains and what industries it invests in, then you are essentially investing blindly. That's why, before putting your money anywhere, always check what is inside the ETF. Because at the end of the day, you are not just buying a ticker, you are buying the companies behind it. The second mistake is that most people simply chase returns. They see an ETF that has gone up a lot and jump in without a second thought, just because it has been performing well. But that is often exactly where people lose money. By the time you see the strong returns, the biggest move has usually already happened. And if you enter late, you are more likely to experience not the rise, but the next correction. Performance alone means nothing if you don't understand what you are paying to get it. That's why we don't chase numbers, we chase strategy. The third mistake is that many investors do not have a clear strategy. They simply buy ETFs because they heard about them somewhere, watched a video, or because someone said they were a good choice. The problem is that without a strategy, every move becomes random. You don't know why you entered, when you should exit, or what your goal is. This often leads to poor decisions, especially when the market starts falling and emotions take over. A good strategy does not need to be complicated. You simply need to know what you are doing, why you are doing it, and your investment time horizon. The fourth mistake becomes clear during difficult market moments. When everything is going up, most people feel comfortable. But as soon as a decline begins, the psychology changes completely. They see their portfolio falling and start to panic. And that is where the biggest mistake happens. They sell at exactly the wrong time. They exit the market when prices are low, and usually stay out when the recovery begins. As a result, they do not just lose during the drop, they also miss the next rise. Because in investing, the hardest part is not getting in, it is staying calm when everything is falling. The fifth mistake is that many investors hold too many ETFs in their portfolio. They believe this gives them greater diversification, but in reality, they are often just buying the same thing under different names. For example, 2 or 3 ETFs may hold many of the same large companies, which means the risk is not truly reduced. Instead of making the portfolio stronger, they make it more complicated for no reason. And the more complicated something becomes, the harder it is to manage. In investing, you do not necessarily need many products. You need the right structure. The sixth mistake is that many investors ignore ETF fees. At first, they seem insignificant, just a few tenths of a percent. But let's keep it simple. If you invest €10,000 and there is a small cost difference, for example, 0.5% per year, over 20 years that could mean losing thousands of euros in final value. And the most deceptive part is that you do not notice it immediately. Fees are taken little by little, every year, without you realizing it. That is why many investors focus only on returns and ignore the real cost. In investing, it is not only about what you earn, but also what you pay to get there. Let's do a quick recap. The first mistake is not understanding what you are buying. The second is chasing performance only. The third is having no clear strategy. The fourth is panicking during market drops. The fifth is overloading your portfolio with too many ETFs for no reason. And the sixth is ignoring fees. If you avoid these, you are already one step ahead of most beginners. Because in investing, it is not the one who does the most that wins, but the one who avoids the biggest mistakes. At the end of the day, investing is not about luck. It is about knowledge, smart decisions, and consistency over time. ETFs may look simple, but that is exactly where many people make mistakes without realizing it. And the truth is, in the market, it is not the one who does the most that wins, but the one who avoids serious mistakes and stays consistent with their strategy. If you enjoyed this video, let me know in the comments which mistake stood out the most for you. And if you want more in-depth videos like this, you can subscribe to the channel to see them first.